So what in the world is going on with mortgage interest rates, Mr. Frost?
They're up, dude.
So I just saw a headline that they're the highest they've been in the last, I think, 2 years is what the headline said. Yeah.
Yeah. So I was looking at a graph, like a mortgage-backed securities, right?
How do you feel about that mic, like all up in your grill? It's a little bit interesting to get used to, but it's okay, right? Hopefully the audience, you guys out there, appreciate the good audio quality.
Yeah, I don't know.
Easy with those fingers up there, because if you hit the wrong button, you'll mute yourself.
I know. You know, I'm new to the microphone and the face game, you know, and that's like when I like public speaking.
Yeah.
One of the things I'm bad at, like if I'm public speaking and there's a podium, you know, I get like, first of all, I get Ricky Bobby.
Yeah.
You know, I don't know where to put my hands. Like
Right.
I talk with my hands a lot anyway.
Me too.
But if I got to hold the microphone, I'm like, do I do like a pinky out? Like, am I nursing it?
Right.
Do I like Tupac it?
Sure.
You know, like I don't really know. I don't know what to do with the microphone when I'm public speaking. So that's literally, if I could get away from that,
you'll be in good shape.
Just microphone, hand management, and like hand management in general,
I get that.
I'd be a lot better. Like if I could just stand behind a podium and just let my fervor only lead the enthusiasm, I'd be in a lot better shape. But instead I have hands and I don't know what to do with them.
I get it. So
Sorry about that,
that's all right. I like that. We digress.
Yeah.
So we made a video end of 2021. Get comfortable over there. At the end of 2021, and we talked about inflation. We talked about the fact that in the last Fed meeting, they announced that they're going to raise rates in 2022, what, 3 or 4 times?
Yes.
But I think the thing that we didn't understand or that we didn't know is that it was going to be so fast. And so here we are, beginning of January 2022, and rates are skyrocketing.
Yeah,
so tell us what's going on.
So there's a couple things that the Fed's like, there's like a few big things the Fed can do to ease to ease their accommodation of easing, right? So the Fed came in when the pandemic happened. So this was like starting. So to answer your first question, rates are looking at the mortgage-backed securities. The rates in that market was at the same level on March 17th of 2020 as it is today. So it was like 2 years. That was like,
yeah.
So in that,
you can make that thing come around you and I'll make it a little longer and then get it in front of your grill.
I'm not uncomfortable with it. I don't know.
Well, there she goes.
I got it. I'm good with the microphone. Do you think
Look
I'm
at
not
that? How
close
much
enough?
more comfortable that is. How's
It's
that?
fine. It's good.
All right, good. Anyway.
But I remember that day because my oldest daughter's Alexis is born on March 17th, and she was having her birthday party for her. I guess it'd be her 9th birthday, right? That was 2 years ago. That was crazy.
Yeah.
2020. She's born in 2010 to her 10th. I don't know, bro. I don't know.
I thought you were the finance guy.
I am. Yeah, I am.
You need a calculator?
Well, no. I know dates, but I don't know years.
That's
so
fair.
I had to do that math because I'm a finance guy.
Yeah.
I was trying to make math problems up. But she had her birthday party, and that, like, as the parents were dropping everybody off, like, did you guys get the message? Like, school's shutting down. Like, we're going remote. Like, COVID's happening. It just so happened that Alexis had strep throat, like, diagnosed the day before. And we like called all the moms and we're like, party's probably canceled unless you don't care. And they're like, we heard stuff is shutting down. Like, we don't care. We're all coming. So that's when that was, and that's like right when we started our company too.
Right.
National Mortgage Funding. And right away, rates went up, right? As soon as this happened, rates went up. They were at like 4.5%. I'm like, dude, this is the worst recession ever. Like, not only is like stuff not working good, like interest rates went up. And then that's when the federal government came in and said, we're buying mortgage-backed securities. We're buying treasuries. We're dropping the Fed funds rate to 0, and we're going all in on our balance sheet to print all the money we need to keep the economy moving.
That's exactly right.
To keep money in people's pockets. So they did all that stuff. So, and they did that before too with the housing market crash, and that's like kind of their push and pull thing, right? Yeah. That's how they work the puppet of the economy.
That's their little toolbox, as you say.
The toolbox.
The toolbox.
And so this happened in 2018, and it's funny because in the United States, we talk all about our history. Our history is so important. Like, you know, you learn from your history, except for the Fed. So in 2018, they're doing exactly what they're doing right now. They're impatient with inflation, and they're impatient with these changes of the accommodations. So they're like, we're going to do this, we're going to do this, we're going to do this, rather than just one at a time. So they've stopped, they're tapering their asset purchases. So they're buying less and less mortgage-backed securities, which kind of spooked the market a little bit. That was fine. We knew that was going to happen.
And that happened, what, a couple weeks ago, probably?
Yeah, it was like a month ago.
Got it.
They're going to start lowering the rate. They're going to start lowering how many they're purchasing. Now, the other part of that is that the Fed's been buying mortgage-backed securities and treasuries. So they own like $8.8 trillion in these bonds. And what happens with the bond is it matures, right? So you get your money back and you get a little interest, right?
Yep.
So what the government was doing was taking their money they were getting back and their little bit of interest and they're reinvesting it. So not only were they buying like $40 to $50 million or $1 billion or 30 or whatever it is, I don't even know how to count that high. So they're buying all these and they're reinvesting. So you're kind of getting a double whammy. Well, the Fed came out and said, we're going to taper faster and we're going to raise rates in March rather than May. So we're going to do that at the same time, which they did in 2018. And they destroyed everything, right? To the point where the Fed had to come back and say, okay, we're backing off.
Right.
You know, and this is the same Fed.
I remember
chairman,
that.
Like,
that's a good
he
point.
learned it. He didn't learn his lesson. Like, they didn't learn their lesson, right? There's just, it's just a strange thing. There's zero patience, right? So then they came back out and they said, not only are we going to move up our raising of interest rates, we're also going to continue our tapering. We're going to stop that in March, but we're also going to let our balance sheet run off. And what that means is that rather than reinvesting these bonds in these markets like they've been doing, they're going to keep the money, right?
Yeah.
So you say, well, okay, fine. Like what difference does that, like, how does all that matter, right? And you go back to supply and demand, which we talk about all the time. So this is like super deep in mortgage stuff, but maybe pick up on like one or two words.
People needed a nap, bro. So
dude, you're talking to somebody at Costco, you bring up mortgage-backed securities and it changes. It's a different level.
Yeah. Well, listen, people watch our show when they're tired. They try to go to bed.
Yeah.
So they put the YouTubes on at night. Yeah. They get their
us.
pillow, and then they listen to you talk, and you put them right to sleep. So keep going.
I know. All right. I got some other stuff I can talk about in a minute. Like I was thinking about airport workers today. That's a whole nother thing. Could you imagine? Like, where do you, like, you work at an airport? Like, I would never know where to go. It would take me 2 years to orient myself with my task.
What in the world are you talking about?
You ever think about that?
Working at an airport?
Yeah.
No, what made you think of that?
I was thinking about that today. I was at Starbucks.
Yeah, but what made you think about working at an airport?
Okay, there were 9 baristas
working
at Starbucks today, and I'm like, how do they all know what they're doing? And then I'm like, you know, you go to the airport and there's a guy pushing people in their wheelchair.
Yeah.
There's a ticket person, but then there's a floater behind the ticket person doing jobs. And then you walk out and there's like a guy doing something else. And then, oh my God, you look out where the airplanes are and there's like 1,000 people all doing different shit.
Yeah, but you're at Starbucks. And how did you think of the airport? How did the baristas at Starbucks say, oh shit, the airport?
Because there were just so many. I don't know. I go back to that anytime I don't understand a job, I find comfort in being like, oh, I can't imagine working at an airport.
You are hilarious.
All right. Do you ever get into that? All right. So anyway,
hold on. I want to real quick. I want to talk about, give context to this conversation around, okay, where were interest rates at, and then where are they at right now? So pull that up. I'm going to pull up a mortgage calculator so we can give the people watching this, like, okay, what does this mean in terms of monthly payment? So go ahead. Talk to us about rates
I have
today.
this off the top of my head. You can put your calculator away. I know it.
All right, good.
So, all right. So at the end of the year, interest rates on a 30-year mortgage, because that's what everybody cares about, was about 3%.
Okay.
Some were like 2.8, 2.9, 3%.
It all depends. You want?
Yeah.
We got it. We got the disclaimer, bro.
All right.
Got it.
So today the average rate on a 30-year fixed is 3.625.
Okay.
So it's 5/8% increase.
Okay.
0.625.
Got it.
You're with me?
Yeah, I'm with you.
So I always break it down like, so I work in mortgages. So everything I do, I live my life 1 month at a time.
Yeah.
You know, I'm like the Dominic Toretto of mortgages.
Right.
So it's 50. So for every $100,000 you borrow, your cost of ownership went up $53 a month.
All right. So you were pricing on a loan for your client yesterday, and you put a video on your Facebook. Like 2 people watched it, which was cool. I'm just kidding. I love you.
Easy. I had like 4 likes.
Yeah, that was pretty good. So give us that story. So like someone was buying a $200,000 home.
Yeah. So I was going through. So as a responsible loan officer, I go every week. I go through all of my pre-approved clients, and I really focus on the ones that maybe were looking on the higher end of qualifying or higher end of their budget, because that's just where the market's leading us, or not everybody's on the loan. So I went through and I try to give all my clients like, look, I know you've heard a lot about interest rates and mortgages. Let me tell you what's going on. So I had a client. They were looking at a $230,000 house, and houses like $230,000 to $250,000. The goal was to borrow $200,000. I mean, that was like kind of their number. So I called him. I said, look, the difference today is that your payment is I think it was like or $840 a month, and it's going up to like $950.
Going up. Why did you say
160.
going up? What do you mean going up? Because
So
did you price this out like when rates
yeah,
were
yeah,
lower?
yeah. So when we went over it in the beginning, so I save a little sheet. And I'm like, these are the payments we discussed, cash due at closing. Like, look, your cash due at closing stayed the same.
Because like 2 or 3 weeks ago, their rate was at 3%.
3%. Yeah. So I'm like, so now you're at $106 more than what we talked about.
Okay.
So, you know, is like I told them, I was like, look, this isn't like a good news call, obviously. Like, you know, it's going to cost you more to move, but it's not the end of the world. Number one, you're going to buy a $250,000 home. Your payment all in is going to be like $1,240. And right now you're renting for $1,600.
Yeah.
You know, so it's not
it's just a headline.
Yeah.
You know, the media, the rates are the highest they've ever been in 2 years. And so the media has a frenzy with information like that.
Yeah.
But then that's why we make this show, is to give people context, like real estate professionals, mortgage people, buyers and sellers, context of what this actually means. Now, with the Fed coming out and talking about, okay, we're going to raise interest rates 3 or 4 times in 2022, what could that mean in terms of a 30-year mortgage interest rate by the end of 2022, do you think?
It depends on a number of things, but historically, so the reason the Fed raises interest rates is because it fights inflation.
Sure.
Right.
Which is a big fight right now.
Right. And inflation, and that's a whole nother topic, but inflation's bad for mortgages, right? People, when inflation's high, that means like your Walmarts, your Best Buy, Whole Foods, whatever your investments are, when stuff costs more, people pay more money, stock prices go up, right?
Yep.
So if you're an investor, are you going to invest in a mortgage, or are you going to invest in something in a stock that's going up at a higher rate, right? So you have to increase your returns on the mortgage-backed securities. It's bad for mortgage rates. Well, what happens is when the Fed raises their rate, what that's doing is it slows down corporate growth, because that's a way that large companies borrow money between banks, right?
Sure.
So that's ultimately slows corporate growth. It fights inflation, which brings the cost of goods down, which means that it makes more sense for borrowers to find a safe haven in that mortgage world, which helps bring interest rates down. So, you know, it's going to be a rocky couple months, right? January, February, into March and April, we're really going to see inflation and this reinvestment talk. I mean, a bond trader could sneeze wrong and they're like, oh my God, rates are up a quarter, you know, and then the next day they'll go back down. So it's going to be really rocky. But I think as summer progresses and we get into late spring, we'll start to see rates come down. And I'll tell you that, I've been doing this for like 18 years. You know, like I went through the recession. I went through the low arms.
You look good. You don't look that old.
I know. Well, you want to know a confession?
Yeah, give me a confession.
So on days when I don't feel like I'm looking that good.
Yeah, tell me, what do you do?
I use shampoo and conditioner in my hair.
Ah, got it.
I don't even have hair, but I'm like, you know what? I'm heading out today. If somebody touches this head, those things are going to be soft.
Got it.
But anyway, I did that today.
Did you?
Yeah.
That's why you're looking so good today.
I know. And I used like a scrub I found in the shower from Lush.
Shoving your, like you're scrubbing your head?
On my face. No, I was like exfoliating. I really went deep. And I don't know if it pays off.
Your skin looks good today.
It's all about how I feel.
Got it. All right. Fair enough.
Thank you. But, you know, historically, this happens every year. We call it mortgage season, right? So the beginning of the year is bad for rates, and you're coming off all these holiday jobs gains because you're seeing seasonal employment. So that's bad for inflation. Companies reporting their revenues, fourth quarter revenues, GDP outlooks. Everybody's excited. The country has a New Year's resolution,
right,
to not do dumb.
Yep.
And then as the year goes on, it all starts to settle itself out, and then summer opens up and it's mortgage season, baby, and rates get better.
So I think, we were talking this morning, we want to kind of pull back the curtain on this show for people watching to educate them hopefully even more. And so the thing with interest rates as it affecting payment is one thing, but I think where it really affects the buyer or homeowner is in cost, right?
Yeah.
Because now it's you can make the argument like, yeah, $100 is not going to do a lot for a lot of people.
Yeah.
But when rates go up, 5/8 of a point, where someone's looking to bring X amount of dollars to closing, talk about the impact that higher rates have on cash due at closing because of the cost of the interest rate. Well, and it depends how you price out the loan, but
right. It depends.
But there's a real cost there.
It can, yeah. So I mean, to put it in perspective of a $200,000 loan. So today, if you wanted to get yourself back to 3%, no, I need a rate sheet.
All right.
Got a rate sheet in there?
I have no rate sheet, but I got
well,
our trusty qualifier
let's just say
plus.
it costs a point, right? Say it costs a point.
To do what?
To get back to 3%.
Yeah, got it.
Because an increased rate has no. So if you're looking at, so in our world, right, 0 points. That's the thing, right? Everybody on 0 points, and so
they don't even know what that means. They just see it on Google and they say, "Ask your mortgage loan officer what their 0 point rate is." And that's all they know. And I want to get into this pricing conversation. Go ahead.
Yeah, there's a ton of adjustments for rates. So and even on a Fannie Mae loan, 800 credit score, you owe 50% of the value of your house. You get a quarter point charge on every loan for being a refi, right? Quarter point in fees. So on a $200,000 loan, it's $500. Now, what do? You can price out a loan and you can price to 0 points, and they'll be like, okay, the rate on that loan is going to be 3.59136. You know,
right?
Here's your rate, 0 points. This is your rate. So in the way that works is you offset fees with rates. So it's a teeter-totter, right? So more fees, lower rate, vice versa.
Yeah. So
higher rate, lower fees.
And what you're saying is, and that's the other thing that I think there's a myth in the marketplace, that the consumer, you can pick your rate. Remember we used to like talk about that all the time?
Yeah.
Like, dude, you could come in. Remember we actually, I'll go back to when we first started the mortgage business together, have the client. This is when people actually came to the office, and you price out their loan with them, and they get to pick their rate.
Exactly.
That can still happen today, and that's 100%. What I really want to. That's the point I want to make around pricing out a mortgage. Is like consumer can have whatever rate you want. You know what I mean? It just comes down to, does it make sense financially? Can you still buy a rate down into the 2s right now?
100%.
Yeah, so that's kind of the point.
You can buy a 15-year mortgage down to 1.75 today if you want.
So that's exactly right. And so the headlines are 3.625 or 3.5%. Well, that doesn't mean that's what your rate has to be.
Right.
If you want a plaque on the wall so you can show people at Thanksgiving, look, my rate's in the 1s, you can have that if you're willing to pay for it.
Exactly. Yeah.
And so cost comes in the form of closing costs. That's what we're talking about.
Yeah.
So on the other side, the whole teeter-totter conversation, you can also help people in a lot of different ways. What you always do is giving them the option of going with a slightly higher interest rate, changes the payment by, dollars per se, potentially. And then their cash due at closing goes way, way down.
Exactly.
Right?
Yeah, exactly. So you can, so points go both ways, right? So if you want a lower interest rate, you pay points at closing. So you want to say, I want to get, I'm at rates are 3.5 and I want to get to 3%. It costs me 1 point on a $200,000 loan.
$2K.
Extra $2,000 into closing, right?
Yep.
Well, it works the same way. So to go from 3.5 to maybe 4%, that'll give you $2,000 to credit toward your closing costs. Now, those totals are a lot more. Like in reality, that's probably going from 3.5 to 4 would get you like $6,000.
Right.
So that would be enough to cover. In lending, you can give as much credit as you want as long as the borrower has at least the down payment in their own funds or gift funds.
So let me ask you this. When I was deep into the mortgage game with you, I liked to show people the difference in getting a higher rate and going against the status quo, because they were more concerned with like how much money was in their checking account than like a monthly payment that was $20 difference. I've been singing this song for 20 years.
Yeah.
And so do you do that? Like when you're pricing on a loan, because society tells the consumer low rate, low rate, do you say, well, wait a minute, Bob, Sue, let me just show you a higher rate and what that looks like in payment. And oh, by the way, you save $5,000 in real dollars when you show up at the closing table in 30 days. Do you do that at all?
Yeah, I do 3. I always do. Here's a loan with really low cost. Here's a loan with really high cost. And here's a loan that makes sense.
Love it.
Every time. And I'm like, you can pick any of the 3 that you want, but this is what I would do, because there's like sweet spots in rate sheets. Like
absolutely,
based on where things are trading, like you can get a good deal by getting down to this rate. But to go any lower could be a jump instead of a step. Yeah. You know what I'm saying?
So we'll have to just pay attention to rates. And obviously we'll give the people updates as we continue to follow interest rates in the housing market. But right now, as we're starting off 2022, things still look to be very, very strong. The housing market's still pushing along. There is no inventory. You were just saying that this morning. Yeah. You got 25 clients looking for houses that can't find anything. Yeah. That's still the story. Yeah. So while inventory stays low, the supply stays low and demand stays high, this is going to push this housing market to continue to stay hot.
I agree. And that being said, there's a saying that says, don't let the tax tail wag the dog.
I've never heard that before.
Don't let the shit. I'm so bad at sayings. But don't let an interest rate guide you in whether or not you can do a refinance or not.
Or buy a house.
Or even buy a house. So I look at people that did, and that I've been making a lot of calls on, and I've had a lot of success, is people that bought a house within like the last 2 or 3 years on an FHA loan where they did 3.5% down, or they did a refi at 95% on an FHA loan. The PMI is never coming off of that loan. As long as you're in that loan and your rate's at 2.5% or 2.6%, that's amazing. But there's a calculation we do in the mortgage world called your effective rate, because your interest is, whenever you're thinking about a mortgage, you think at what your cost is to have that money.
Right.
You're using somebody else's money. So what's your cost to have that? You pay two things. You pay interest, then you pay PMI, because the principal, you're just paying yourself back. That doesn't mean shit. That's not a cost.
Right.
You borrowed it and you're just giving that back, but your cost is your interest and your PMI. So there's a calculation that we do in mortgages where we take the principal and interest payment, we add your PMI, and we put that as your payment. We set your loan term, we put your loan amount in, and then we solve for interest rate, right? Do a little algebra. And those rates, even at 2.5, that effective rate's in the 4s. So if your credit's gotten better or your situation's changed, you're in this market where values are up 18 to 22% over the last 2 years. Like, this is your 2.5% doesn't mean because you're paying this PMI that's never going to go away, that is only going back into the FHA pot to give new people loans. Like, it does you no good. So my parting thought is
your closing statements.
Yeah. Is don't let the interest rate guide you in your decision making. Like, your payment guides you. Never ever are you going to write how much PMI is, and never ever are you going to write what your interest rate is on your, like, nobody puts in the memo like mortgage payment for 2266 Parkdale Drive, 4% biatch. You know what I'm saying?
Yeah,
like,
that's our thing, and that's where you and I really see things eye to eye. It's like, you're exactly right. I think it's just society has taught the consumer to be so rate focused that sometimes we forget common sense. And 100%. There's a lot of situations where pricing on a loan to get a 1/4 point higher interest rate changes your payment by $6, and you bring $4,000 less to the table might make more sense.
Yeah,
right.
I agree.
So we'll let's pay attention to this, and we'll come back next week and we'll give the great people an update.
Awesome.